Most people imagine global power expressed through flags and summits, not invisible networks shaping sovereign financial destinies quietly. Yet history suggests real authority often emerges from creditor groups influencing governments far more than public realizes. Today we investigate how powerful bondholders helped elevate the IMF into a dominant global economic force. This story challenges assumptions about how institutions gain leverage and why nations surrender policy freedom silently. To understand the IMF's rise, we must examine earlier decades when sovereign debt markets were rapidly transforming. After World War I, governments borrowed heavily, creating opportunities for banks underwriting massive international bond issuances. These institutions formed informal creditor blocs whose influence exceeded anything previous eras had witnessed. Though not conspiratorial, their aligned incentives effectively shaped borrowing conditions across struggling post-war nations. These developments created structural patterns that later empowered international institutions like the IMF significantly. But to see how we travel to 1944 in the historic Bretton Woods Conference. Delegates sought stability after depression and war, constructing rules guiding global finance for decades ahead. Two intellectual giants dominated negotiations: John Maynard Keynes and American Treasury official Harry Dexter White. Keynes favored balanced mechanisms preventing creditor domination, while White preferred systems supporting American financial leadership. White's vision ultimately prevailed, embedding rules ensuring global liquidity management favored creditor stability. From inception, the IMF was designed to oversee exchange rates and reinforce repayment confidence internationally. Many investors welcomed this arrangement, viewing the IMF as a stabilizing force protecting sovereign bond markets. But no one foresaw how crises would transform the IMF into a powerful global policy enforcer. The first major test emerged during Latin America's debt crisis in the early 1980s. Countries borrowed cheaply during the 1970s, unaware rising interest rates would soon devastate their finances. When U.S. monetary tightening exploded global borrowing costs, Mexico and others faced catastrophic repayment challenges. Major banks feared default contagion threatening their balance sheets, pressuring governments for coordinated intervention. The IMF stepped in, offering emergency loans contingent on strict structural reforms and fiscal discipline. These programs protected creditor interests while imposing austerity measures, reshaping national economic priorities dramatically. The crisis expanded IMF authority, establishing patterns where market turmoil increased institutional influence significantly. A second wave erupted during the 1997 Asian financial crisis, sparked by Thailand's unexpected currency devaluation. Capital fled rapidly, destabilizing South Korea, Indonesia, Malaysia, and several neighboring economies simultaneously. International investors, today's bond funds, and institutional creditors panicked, accelerating regional financial collapse. The IMF launched large rescue packages requiring tight monetary policies and extensive structural reforms. Critics argued conditions favored creditor stability over domestic economic welfare, intensifying public dissatisfaction. Regardless, the institution's influence deepened across Asia, reinforcing its global leadership role further. By early 2000s, sovereign debt markets had become increasingly unified, liquid, and globally interconnected. Institutional investors like pension funds, insurers, and asset managers collectively influenced government borrowing conditions. These entities shared similar risk incentives, effectively forming modern creditor blocs through market behavior alone. Ratings agencies strengthened this dynamic by assessing sovereign creditworthiness with enormous global consequences. In such an environment, the IMF became vital for managing crises threatening international investor confidence. The Eurozone crisis revealed this interdependence more clearly than any previous event in modern history. When Greece's deficits became unsustainable, European banks confronted potential losses threatening continental stability. The IMF joined European institutions forming the Troika, administering dramatic austerity programs across Greece. Economic contraction reached staggering levels, while creditor exposure diminished through orchestrated financial backstops. Even IMF officials later acknowledged miscalculations that underestimated devastating impacts on Greek society. The episode nonetheless expanded IMF influence into advanced economies previously resistant to external conditionality. Through each crisis, a pattern emerged. Instability increased, and institutional authority grew correspondingly stronger. This rise wasn't conspiracy, but predictable consequence of markets demanding unified crisis management mechanisms. The IMF provided those mechanisms, reinforcing a silent yet powerful governance structure, shaping national decisions. Debt became not merely financial, but a geopolitical force determining policy trajectories for indebted countries. Modern creditor networks act collectively because incentives align, not because coordination is secretly orchestrated. When risks appear, investor expectations converge, pressuring governments toward IMF-backed stabilization programs. These programs often require austerity, privatization, and regulatory reforms impacting long-term national development paths. The system's strength lies in its structure, not malicious intent or covert organizations manipulating outcomes. Nonetheless, the dynamic concentrates power upward, diminishing local autonomy during financial emergencies. Attempts to rebalance this arrangement have repeatedly struggled due to political and economic constraints. Emerging markets sought greater IMF voting influence, but reforms progressed slower than many nations desired. Debt relief campaigns achieved limited wins, though structural change proved difficult without creditor cooperation. Calls for a sovereign bankruptcy framework faced resistance from investors fearing precedent-setting debt write-downs. Nations worry resisting markets could trigger capital flight, worsening economic conditions almost immediately. Consequently, proposed alternatives rarely advance, leaving existing structures largely intact despite widespread critiques. Meanwhile, global debt has surged to unprecedented heights, surpassing previous historical records significantly. Over 60 nations currently face high debt distress, signaling rising vulnerability to future financial shocks. Bond markets react quickly, punishing perceived risk through rapid sell-offs and elevated borrowing costs. Ratings downgrades amplify pressure, often accelerating financial instability before governments can implement corrective measures. Once again, the IMF finds itself central to crisis response, offering stabilization in exchange for reforms. Critics see this as institutional overreach. Supporters view it as essential global economic insurance. Both sides acknowledge that debt structures empower creditor interests, regardless of intentional coordination. The term bond cartel reflects perception of unified pressure from investors defending asset values collectively. Though decentralized, these forces significantly shape national policy, especially during moments of heightened volatility. IMF acts at this intersection, mediating demands for stability with requirements for domestic governance. This role grants enormous influence, often surpassing the authority of national legislatures during emergency periods. Understanding this dynamic requires recognizing power emerging through systems, not clandestine conspiracies. The IMF's ascension occurred because global finance needed centralized crisis management more than ever before. Yet this necessity created trade-offs, limiting sovereignty for nations dependent on external financial support. Historical patterns show crises repeatedly expand institutional influence while diminishing grassroots democratic control. The next debt crisis will likely amplify these dynamics unless structural reforms redistribute financial authority. 3 lessons emerge from examining the IMF's silent yet powerful evolution across multiple global crises. First, financial systems inevitably privilege creditor stability, shaping institutional behavior during emergency interventions. Second, crises generate opportunities for organizations like the IMF to expand their reach significantly. Third, sovereignty becomes fragile when nations depend heavily on external capital and international stabilization mechanisms. These lessons suggest understanding debt structures is essential for safeguarding long-term national independence. Citizens must remain aware of how financial rules influence policy decisions affecting everyday economic life. Without awareness, complex systems accumulate power in ways few notice until constraints become visible. The IMF's authority illustrates how institutions grow through necessity, legitimacy, and repeated crisis engagement. But necessity also creates vulnerability when decisions become detached from democratic accountability mechanisms. The question becomes whether future reforms can balance investor confidence with national autonomy fairly. Achieving that balance requires cooperation among creditors, institutions, governments, and civil society groups worldwide. Ignoring structural pressures, risks, repeating cycles where crises transfer authority upward permanently. A new global framework may eventually emerge, though history suggests institutional change moves slowly. Until then, the IMF will likely remain central to international financial governance for years ahead. The challenge lies in ensuring this power serves collective well-being rather than narrow financial interests exclusively. Understanding these dynamics empowers viewers to critically assess narratives surrounding debt, crisis, and sovereignty. If you value deep explorations of hidden financial mechanics, subscribe and join future investigative episodes. Together, we'll continue uncovering the forces shaping our world and the systems guiding tomorrow's economic landscape.